Get ready for massive business moves. Firmament-backed BP Environmental Services has just completed huge acquisitions, bringing together Commercial Management Systems and General Equipment Acceptance Corporation to supercharge their nationwide platform for waste and job site solutions. This deal is set to redefine how these critical services are delivered across North America. We dive into the details of this major expansion right now.
Here's a simple way to protect your phone without stress. This ALAN 3-pack comes with tempered glass screen protectors, camera lens protectors, and an installation frame for an easier, cleaner fit. It's clear, case-friendly, and built to help guard against scratches and everyday bumps. Check the link in the comments to get it on Amazon.
Next up, we look at the turbulence hitting the energy sector. NOV is feeling the real-world effects of geopolitical tension, and we break down exactly how freight bottlenecks are squeezing margins, even as the company maintains a strong backlog. Find out if this is a temporary timing issue or a fundamental shift in customer appetite for NYSE, NOV. The global energy map is being redrawn. We explore how the Hormuz risk is forcing a complete reevaluation of supply chain geography, examining Japan's talks with the UAE and ADNOC's massive project awards, and why optionality is becoming the most valuable asset in global logistics. This is a deep dive into risk-adjusted network design. Finally, we look at global logistics expansion. FedEx is making a huge commitment to Poland with a brand new logistics center in Olsztyn, significantly boosting their capacity to serve growing international businesses. Don't miss these crucial updates shaping the future of commerce. Stay tuned right here for the full breakdown. BP Environmental Services has significantly bolstered its position in the North American commercial waste and job site services sector by completing the acquisitions of Commercial Management Systems, LLC, or CMS Logistics, and General Equipment Acceptance Corporation, or GEAC. This strategic move marks a major milestone in BP Environmental Services' ongoing expansion as a leading, tech-enabled, asset-light provider of mission-critical solutions for multi-location customers across the continent. The acquisition of CMS brings a technology-enabled platform offering managed waste, recycling, and job site solutions. Complementing this, GEAC provides tailored lease and rental solutions for essential waste handling equipment, including compactors and balers. Together, these additions enhance BP's nationwide managed services capabilities, deepen its equipment leasing portfolio, and strengthen its capacity to deliver comprehensive, single-source solutions for customers with complex operational needs. Tom France, CEO of BP Environmental, expressed enthusiasm for the integration, stating that both acquired businesses bring capabilities highly complementary to the existing platform, expanding service offerings across waste, recycling, equipment rental, and job site services. Brian Peters, principal at Firmament, noted that the combination of CMS and GEAC creates a natural fit, unifying complementary service and equipment capabilities under a single nationwide platform. Michael Hendry, managing partner at Expedition Capital Partners, emphasized that this move advances BP's core strategy of building a unified nationwide platform integrating service, equipment, and technology, signaling a focus on scaling the company. BP Environmental Services is dedicated to reliability, efficiency, and innovation in waste management solutions. The acquisitions position the company to better meet the evolving demands of its commercial clientele. NOV, a global supplier of equipment and technology to the energy industry, is experiencing margin pressure in the first quarter due to supply chain and logistics challenges stemming from geopolitical tensions. While first quarter revenue of $2,052 million remained near the prior year's $1,103 million, net income fell significantly to $19 million from $73 million, resulting in diluted EPS dropping from $0.19 to $0.05. The key takeaway for investors is that management attributes this decline in profitability not to lost customer demand, but to freight bottlenecks, routing changes, and shipment timing issues. This distinction is crucial for separating temporary operational noise from fundamental changes in the order book. The central focus for NOV moving forward will be the speed at which the company can convert its existing backlog into recognized revenue, and whether freight and routing costs stabilize in subsequent quarters. If shipment schedules normalize, the current period may represent a timing reset rather than a reduction in customer appetite. Investors tracking NYSE, NOV should monitor how quickly NOV resolves these execution timing issues. Guidance for the second quarter of 2026 projects a 4% to 6% year-over-year revenue decline, underscoring the need to watch whether management's commentary continues to frame disruptions as timing matters rather than demand erosion. Tracking management's updates on tariffs, logistics contracts, and supply route changes will be vital as these operational details directly impact profitability and valuation. NOV continues to operate in the design, construction, and manufacturing of systems for the oil and gas drilling, production, and industrial renewable energy sectors, supported by a flawless balance sheet and moderate growth potential. Noi Dung Kai Tight. Hormuz risk is fundamentally reshaping the global energy supply chain geography, signaling a definitive shift from purely cost-driven network design to risk-adjusted resilience strategies. The strategic implications are being felt across energy importers, manufacturers, and logistics providers worldwide. /N the Strait of Hormuz, a critical choke point for global seaborne oil, is no longer just a regional security concern. It represents a structural dependency embedded within global sourcing and transportation strategies. Recent instability, including the pandemic, the Russia-Ukraine war, and Red Sea disruptions, has underscored a crucial lesson. Critical nodes are assumptions built into sourcing, inventory, and cost models, and when those assumptions fail, investment logic must change. /N Japan's engagement with the UAE on expanded crude supply and joint stockpiles exemplifies this pivot. The discussions aim to secure greater energy security and routing optionality, recognizing that reliance on a single choke point can dramatically impact energy prices and industrial production economics. The strategic value of alternative logistics paths, such as those via Fujairah, which bypass the Strait of Hormuz, is becoming paramount for energy importers. /N traditional supply chain strategy prioritized efficiency, lowest landed cost, and lean inventories. However, geopolitical volatility necessitates a move toward risk-adjusted design, valuing alternate routes, backup suppliers, and flexible capacity alongside cost. Resilience is now being physically built into the network. Ports, pipelines, storage terminals, and industrial localization are evolving from mere economic assets into essential resilience infrastructure. /N ADNOC's substantial project award program further illustrates this trend, linking energy investment directly to supply chain infrastructure development. The UAE's geographic advantage, enhanced by infrastructure like Fujairah, is becoming a strategic asset for buyers seeking route diversity. /N for supply chain executives, the mandate is clear. Energy exposure must be treated as a network design variable. This requires integrating geopolitical choke point risk into sourcing, inventory, and production decisions. Supplier risk scoring must extend beyond financial health to incorporate geographic dependency, trade lane exposure, and energy reliance. /N technologically, the challenge lies in moving beyond siloed systems. Traditional planning tools cannot adequately model the propagation of disruption across energy costs, procurement, production schedules, and customer commitments simultaneously. The future demands integrated systems, advanced analytics, knowledge graphs, and AI-enabled decision systems capable of mapping a disruption against the entire network, suppliers, lanes, facilities, and margins, to determine available options before a service failure occurs. /N in conclusion, the world is not abandoning globalization, but it is actively building escape routes. The practical challenge for leaders is to identify the Hormuz-like dependencies within their own networks, be it a supplier, a port, or an energy source, quantify the exposure, and proactively build optionality. Resilience is now defined by the physical infrastructure and operating procedures that enable rapid adaptation. Federal Express Corporation, the world's largest express transportation company, has significantly bolstered its presence in Poland with the launch of a new logistics center in Olsztyn. This strategic investment is aimed at supporting the international expansion of local businesses by providing enhanced access to FedEx's global road and air network, which spans 220 markets worldwide. The decision follows a clear trend. A recent Mines and Roses study for FedEx indicated that 86% of Polish companies already engaged in international sales plan to enter additional foreign markets. To capitalize on this growth momentum, FedEx has substantially expanded its local infrastructure. The new Olsztyn facility features an increased warehouse space of 50% and a one-third growth in office space, covering approximately 2,500 square meters and significantly boosting regional operational capacity. Marius Mick, Vice President of Operations for Nordics and Eastern Europe at FedEx, stated that the expansion strengthens the company's ability to support customer growth, connecting Polish businesses with global customers often within hours through comprehensive services, including customs clearance and final delivery. Geographically, the facility is situated in Olsztyn's developing business zone, adjacent to the Southern Ring Road junction, offering direct access to major European transport corridors and the S7 expressway, which provides quick access to Gdansk Airport. This connectivity links the site directly to the global FedEx air network via the European hub in Paris. The infrastructure is highly advanced, featuring 56 courier ramps in a marina layout, 4 loading docks for various vehicle types, and additional ramps for palletized shipments. The center is also equipped with a modern automated dimensioning and weighing system and is specifically designed to handle non-standard shipments, including dangerous goods, catering to sectors like chemical, automotive, and healthcare. Poland remains a vital market for FedEx in Central and Eastern Europe, where the company has operated since 1990, continuously upgrading logistics to support exporters and e-commerce. With over 40 locations across Poland and service to 3 major airports, FedEx maintains a significant operational footprint. Across Europe, the company manages 27 road hubs and over 550 facilities, processing an average of 2 million shipments daily. Globally, FedEx connects 2.5 million shippers with over 200 million recipients daily. This expansion is part of a broader strategy, including over 20 new or upgraded facilities across 6 countries, such as recent additions in Legnica and Olsztyn, which collectively aim to deliver faster delivery times and greater flexibility for businesses operating both domestically and internationally.